Welcome back to Everything Money. It's Seth, as always. Yes, I know this shirt is rad. Paul, you got to love this shirt. I mean, this
it's a great
really
shirt.
Bringing the hammer. It's raining here in Ohio. Today is, what is today? Thursday, something?
29th.
The 29th.
Did you wish Andrew a happy birthday yesterday? It was his 40th.
I
Good
did.
For you.
I wished Andrew a happy birthday twice, and he didn't respond to either one of them.
He's a busy man.
It
is Thursday, July 29th. We are looking at Apple today. I myself, I have 17 iPads, 4 phones that don't work. I have all the computers. We have 3 Macs. If you've watched our channel, we love Apple, everything about it. Mo, you got your new iPad. How's it going, the iPad
it's
Pro?
awesome. It's amazing.
We should get that set up for your morning show, by the way. And Paul, you just love FaceTime. You clinically despise people who don't have iOS products. Is that true?
Funny, though, because I prefer PCs on the computer, but everything else, I much prefer Apple.
Today, we're looking at the Apple stock price. We're looking at our fundamentals behind the price. We're going to look at our 8 pillars, see all the ins and outs of this company, an astounding company, Paul. Let's get into the numbers right now for those nerds out there who are interested in the numbers behind Apple.
So interesting. Years ago, a big Apple fanboy called me and said, Paul, on a fundamental basis, what do you think of Apple?
Go on.
I think it was selling for like 13 times earnings at the time. Look at it right now. It's a 28 PE. So it's still an X, but look at that profit margin, 25% at the bottom line, check. Their iPhone sales went up 50% in the last year. So I said to him, fundamentally, the company's phenomenal. The question you have to ask yourself is this going to continue on? And I believe that this was in about 2016 or 17. And look at their revenue from back then. It has gone nothing but up. That was my concern. Whenever it comes to any company that dominates a market, I mean, how do you get bigger market penetration than Apple, right? I mean,
the crazy thing with their iPhone sales, they typically order about 75 million iPhones for the next year. This year, they've ordered 90 million iPhones that they want built for the iPhone 13 or whatever it's going to be called.
Jeez, okay. Yeah. So anyhow, one of the things, this adorable little dividend of 0.6%. They pay out $13.9 billion in dividends versus their cash flow last year of $90 billion in free cash flow in the last.
Are you burping up McDonald's?
That made me burp up the.
It's funny to see 0.6% is $13 billion.
Isn't that incredible? Because the market cap here is $2.4 trillion, guys.
Jeez.
This is the biggest, right?
Yeah, that's the biggest.
This is the biggest company in the world. I remember when hitting $1 trillion was like an unheard of thing.
Yep.
And now this is $2.4 trillion. I do think it's expensive, but look at this return on assets and return on invested capital. 24% and 26%. I mean, this is an incredible company. This is a company that was left for dead. I remember 22 or 23 years ago when somebody I knew wanted to buy an Apple, and a computer tech guy I knew goes, what a dumb idea. And now you don't find a single tech guy who's saying, oh no, everybody says Mac, right?
I saw a cute TikTok, I guess in Forrest Gump, when he's kind of rounding out the end of the movie, he says that he got into this
fruit store.
This fruit store
company.
And the stock price when that movie was made was $0.25.
Compared to now?
It's incredible.
$0.25. Not $0.25 of the price, 0.25,
yes,
as in 25 cents per share.
Incredible.
Yeah. So anyhow, look at this revenue growth, Uncle Seth. 223 to 347. That's a massive check. And look at the last year. 273 to 347.
Jeez.
Yeah, that's a 30% increase almost, isn't it? 25% increase.
I know they crushed it with all their iPad and Mac sales from people staying at home.
Profit growth is pillar number 4, Paul.
46 billion to 86 billion.
Oh my God.
Now, the next one is, I think, the reason why people are going to love it even more.
Shares outstanding, Paul.
20.78 billion down to 16.6 billion. And even, look at the last 10 years, 26 billion down to 16.6. They've decreased their shares outstanding by almost 40% in the last 10 years.
So I love what I'm seeing, Paul, but have we missed the boat here? I mean, this thing's completely exploded. Why would we ever buy this? I mean, isn't, value investing, buy low?
We will do our stock analyzer tool.
I'm
and by the way,
already.
guys,
Go ahead, Paul.
If you see this software was created because so many people asked me, where are you getting your software from? And we finally said, okay, I was paying $200 a month to get basic software from YCharts. Now I do this right here. Guys, this software is incredible. It provides all the financials. Look at everything you get with this software. You ready? We have a mobile app right now, so you can do this all on your phone. All these other competitors, they don't even have a mobile app. We have the mobile app. 8 pillars, 30 years of financial data, stock analyzer tool, daily content exclusive just to people who pay for the app. access to all three of us, real estate calculator, stock screeners, retirement calculator, Discord community with I think we have 4,400 members, people who buy the software right now. Cancel at any time. And look at this, guys. 80 cents a day. It used to be $8 a month. It's on its way to $49 a month. For right now, 80 cents a day. It gets you all of this versus $200 a month, $200 a month, and $35 a month.
You can join the Patreon
No-brainer.
right now. Click the link below, and soon we will be moving off Patreon. We'll be able to go just to everythingmoney.com and go ahead and sign up, and we'll get cheaper rates, Paul. Well, how would I say this?
There'll be deferred taxes. So right now, Patreon charges you sales tax. We don't need to because of our size quite yet. You at least save the sales taxes for a long time coming. It's 80 cents a day. Please don't be crazy because it's going to $49 a month here soon.
Okay, Paul, let's head over to the balance sheet for Apple. Go ahead.
All right, so guys, the total current assets, which is cash and cash equivalents, is $121 billion, and total current liabilities is $106. So they have plenty of cash on hand to pay their current bills outstanding. And now, Seth,
Free cash flow, baby.
the big mamma jamma.
I love this. Go ahead.
Guys, look at this free cash flow.
Oh, my God.
$54 billion to $90 billion. Now remember, guys, free cash flow is important because this is the money that's going to be used to pay dividends, make acquisitions, buy back shares, pay down debt. This is the real way to look at a company's financial strength. Earnings are important, and over long periods of time, free cash flow and earnings should be pretty similar, but free cash flow is a harder number to manipulate. Earnings, I'm not saying it's manipulated, but there are all these SEC and accounting rules that can change the actual cash coming in and out on how you look at it. So I always go to free cash flow. The average over the last 5 years, $65 billion. We always want to start by multiplying it by 20. That's a $1.3 trillion value. So it's an X there. Now,
The current market cap is $2.4 trillion.
so it has to fall by almost half. Now, the most common question you get is, why'd you pick 20? It's a starting point, guys. When free cash flow is increasing, you got to pick a higher multiple than 15 because over long periods of as it's increasing, you don't want to give less credit to recent years that are higher. I mean, if you look at this, $90 billion last year, if you want to pay 20 times that, that's $1.9 trillion versus the 1.3 if you go over the last 5 years. You should clearly give more value to recent years if you believe that's a stable number. As I said, 5 years ago, my question was always, can Apple maintain its market strength? Remember, guys, it's tech. We talk about companies. Look at Intel. The most common question we get about Intel is, Paul, Intel isn't the market leader. AMD's taking up too much market share. There will be a time at some point in the future where Apple is not the most dominant company in terms of phones and all. Look at cars. We've had hundreds and hundreds of car companies, thousands of car companies the last 100 years, and GM and Ford have been dominant, but Toyota, Honda, Kia even in the last 20 years has come out as a big market leader in cars. So you have to remember that. And when you're buying for the future, you need to remember when you're analyzing a stock for the future, can this company sustain its growth that's already had? So let's go to Mo on the charts, and then I will put the input into the stock analyzer tool, and we'll determine how much to pay for the company.
Yeah, last year, prior to COVID, this was a $66 stock, so falling in half is not completely absurd.
Wait, it was $66 before COVID?
Yeah, and then after COVID, it only fell down to 63 something.
Oh, wow.
61 and a half.
Wow, impressive.
Yeah, Mo, are people trading Apple in the Bid-Ask Nation?
Yeah, this is actually one where this is a Mo's trade, and it was in the Employed Trader series. We caught it right through the sweet spot, added right here, and we caught this entire run up, and we sold it right around here, about $150. So that was a 12 or 13% gain that we had in the Employed Trader series. So that's a good sell for that. But what are we going to do now? So it's at all-time highs, and it's just kind of testing them and just kind of consolidating in this area. So they just reported their earnings. There wasn't much price action to it. So now it's just going to be, Apple's going to do what they do. We're going to start hearing things about the new iPhones coming out. If they do, in fact, start making all-time highs again, which is very probable for them, and the stochastic just keeps going sideways, just stay in it, hang in it, enter it for the first time if you want. But if you enter this, enter on new highs because you want the highest probability to make money, and entering on those new highs is going to give you that option.
Because of momentum?
Yeah.
If this resonates with you, the Employed Trader series is a Patreon group where Mo guides you. If you don't have time to do this on a daily basis, Mo alerts you when to buy, alerts you when to sell, and people are definitely making money in this, and it's part of our Patreon. Paul, let's get over to Stock Analyzer tool as another part of our incredible software. Go ahead.
So guys, what the Stock Analyzer tool does, it does one of two things. One, if you want to start with a general idea, which is what we do right now, we're going to put in some assumptions, low, middle, and high assumptions, and it's going to give me a range of what I should pay for the stock. That's kind of tell me, hey, is it within the ballpark at least where I should go do some further looking? The other option is after you've done your further looking, you put more exact numbers in to determine exactly what you need to pay for the stock. So going here, it's going to give me my revenue growth numbers over the last 1, 5, and 10 years, right? Share change, same thing, profit margin, etc. Go down the list, free cash flow, PE. When you join our software, this video will teach you how to use this. This video will be updated as we add more attributes. Now, in the last 10 years, they've done 10% a year, 5 years, 11.6, 1 year, 27. So it's increasing. However, I just have a hard time seeing how a $350 billion revenue business can grow at 10, 20% a year for the next 7 years. And by the way, I'm doing a 7-year analysis. So I sat here and put in 5, 8, and 11. Okay, 11's a high number, very high number. In fact, if you go do the math here, 11% per year for 7 years would take their revenue to $720 billion in 7 years. Is that possible? Of course. But our question is?
Probable.
Is it probable? I don't know. So, share change. They've done between 2.5% buybacks and 5% over long periods of time. So I put in 2%, 4%, and 6%. Profit margin, it's pretty stable here. I mean, they're pretty much staying in the same area. So I put in 22, 24, and 26. Free cash flow, as a percentage of revenue, I basically put in the same numbers. Now PE. The current PE is 28, right? Yeah. This is a big company. Unless you see major growth potential out of the company, I always start with 12, 15, and 18 as my standard for very large businesses. Because once they get so large, you pay a higher multiple of PE and free cash flow if there's a lot of growth potential. As this company gets bigger and bigger, the growth potential decreases. For those of you who don't understand that concept, just think about it this way. If you were worth $1 million or you're worth $100 billion, which one's easier to double?
Of course.
It's easier to double $1 million than $100 billion, right? Same thing here. They have $350 billion in revenue. It's going to be harder to double that than it would to double $350 million in revenue. So I put in 12, 15, 18. And in terms of my desired return, I put in 15, 12 and a half, and 10. I hit the analyze button. Now, the stock's currently at 145. It's telling me the low assumptions makes the stock worth 60, the high assumptions 208. Now keep in mind, I do think my low assumptions are very low. I'm expecting a 15% return on my money. I'm only assuming 5% revenue growth. I'm only assuming 2% buyback, which they've clearly stated they want to do more. So I don't think I should look at the low end. I do think it's somewhere in the middle. I do think I would be buying around 110 or 120. So we're not far off from where a value investor would buy. A value investor. I do believe the stock is probably worth 145 today if you want about a 10% return on your money. I do think the stock price today is a reasonable stock price to pay if you're wanting to get 10% return on your money. Mm-hmm. Now, as a value investor, I want a higher return.
Sure.
But if you want a great company at a reasonable price, I think this is why Warren Buffett and his crew like this company. Because I'm looking at this saying this is a phenomenal company, high return on invested assets, invested capital, high return on assets, buying back shares. I don't think it's unreasonable. By the way, if you assume they're going to grow at 8% a year in revenue, which I still think will be hard, but let's put that in there. Let's assume instead of on the middle assumption, they do 5% revenue growth. Okay, so it's probably a little high there. Look how much revenue growth affects the middle number. Now it dropped to 93, 94. So I still think the 120, 110 number might make a sense for it. If you're paying today's price, I don't think it's awful. So I look at it going, okay, maybe so. I mean, I don't think I'm not floored by Apple. I'm not sitting there going like, oh my God, avoid this. I'm sitting there saying, okay, I don't think it's that far off. If anything, it could be right in the money of where you should be paying for it.
As we close the video, Paul, I have a question. Again, the show is I bring sort of dumb questions to this and sort of normal person questions. A very famous YouTuber who watches all of our shows, like, why is Apple buying back shares? We all know that you could just you could double your shares and that will double your market cap and get a lot more people invested.
By the way, it actually wouldn't. If you really double your shares tomorrow, your stock would plummet. That YouTuber you're talking about is absolutely stupid. They don't understand the concept of shares outstanding. Anyone who thinks that if they double their shares tomorrow immediately, that they would double their market cap is absolutely the dumbest. You should not be listening to that person. That person also calls himself a value investor. Value investors do not like dilution. The last thing value investors like is dilution. You can say all day long, I'm a value investor, but if you don't act like a value investor, not understanding growth, not understanding value, then you're not a value investor. It's absolutely stupid. Do not listen to that. If a company comes out tomorrow, what's it called? Carnival Cruise Line didn't even announce doubling shares. They've announced 2 share issuances and the stock fell. Just from 2 simple shares that weren't even huge. The stock fell. Why? Because people don't like dilution. It's just absolutely asinine to think that issuing more shares increases your market cap. If you do a small amount, yeah, temporarily, but over time, people start to realize that because your earnings per share will decrease. And at the end of the day, go read any report. They're going to sit there and say earnings per share were this, earnings per share were this. And if you're going to pay a multiple of earnings per share, the higher earnings per share are, the higher your stock's going to be worth. That's very simple.
That is our take on Apple. Wonderful company. Paul, it's still maybe in the wheelhouse of a buy, and we'll certainly be buying all the products. And if it falls back down to sort of the mid-range levels, I'm certain we'll be buyers as well. And if you're trading it, Mo, it's just a great company.
Company you can make money on.
Yeah, that's our take. Final thumbs up on the way out, and we'll see you in the next video. Appreciate it.